I welcome all of you for the study circle meet. We have Mr. Mohan Lavi today to share his views on IND AS and key journal entries. I would request Chairman to escort our speaker and hand over a bouquet. As we are aware, most of the companies are voluntarily adopting IND AS, and IND AS has become the day-to-day reporting aspects of our life. So I take this opportunity to introduce today's speaker, Mr. Mohan R Lavi, is a qualified chartered accountant in 1989. He has over 25 years of experience in industry across various industries. He has worked in senior position in finance, in manufacturing and software companies. He also has over 6 years experience in practice. At present, he is the partner of Mrs. KP Rao and Co, Chartered Accountants. And he is also the author of many books on IFRS and IND AS, key audit matters. And he's also guided on various accounting standard, IFRS, and he's also has an expertise in SOX. And he's also GST faculty of our own institute in our various certification courses and registered valuer programs. So I would call upon Mr. Mohan Lavi to take the course. Before that, I would like to have our chairman to have few words in this regard.
Respected Speaker Mohan R Lavi, my mentor and good friend, committee members in the managing committee, and members present virtually and physically. Welcome you all for the today's program on key journal entries and workings of IND AS. After takeover, this is the first physical and virtual dual mode program we are conducting. And I request through this mode, members to join more and more for physical program, because last 2 years we had virtual, still the people are intent to sit back in office and watch our programs, but I request members to join so that we can have that fellowship and we can meet one-to-one. This the intention behind this session, moment before taking over, I discussed with Lavi sir. He said lot of people will be hearing about IND AS, but some of the youngsters, they will not be knowing what are the key journal entries or workings, what they want to do while preparing the financials based on IND AS. It is better to have this program. Then I said immediately, I said yes, we can, because Lavi sir is a key faculty on IND AS and GST matters across India. He'll be traveling all over India for on that program and many other subjects also. Moment he said, I agreed, but it's very interesting also. It's a fact also. Even though we'll be, many of the very few people are practicing on IND AS, but they'll be confused with what journal entries, what workings they have to do. But we cannot limit this program only for this session. It's only a 2-hour session, but we have many IND AS standard. We need to have a continued session. Looking at the interest of the members, we can continue this program with sir's time permits. We can conduct this program. Anyway, happy that Mohan Lavi sir is a part of this program, and I wish you all for a happy learning. And our upcoming programs in March, we have a first program on we have some few programs in March. In that major program is bank branch audit on 19th. I request it will be in Chancery Pavilion. I request members to join that program. And we have a program on faceless assessment and reassessment. This program is going to be addressed by our Padamchand Kincha sir and Chaitanya sir. Please join that program. And investment opportunity for Rudramurthy. And many more programs are there. I request members to join physically as well. Anyway, dual mode is there. You can opt anything, but request you to join physical mode and make a program successful. Even faculties also feel interested if you see interact with members. That is the thing. With this, I welcome you all once again. Happy learning to you. Over to you, sir.
Okay, so good evening to everybody present here and those who are also joining this online. I believe that a sizable number are also online, which as Srinivas rightly said, I think this is something we've got used to in the last 2 years. The advantage in an online session is more number of people actually join. Disadvantage is the speaker doesn't know what the other person is doing. We just keep speaking and, we assume that they are listening. At least here, there is a advantage of knowing that audience is physically present in front of you. But yeah, thank you, Srinivas, for this introduction and also Pramod for that kind introduction. The thing was that he did ask me about a program to be done immediately after he joined as a chairman, and I thought that we should probably do this program because over the last 5 years, India has implemented IND AS. We have come to a situation wherein a lot of IND AS implementation has been done across a variety of industries, but there have also been a lot of mistakes which have crept up in those IND AS implementations. Mistakes, most of the mistakes are probably not mistakes which have been done wantonly, but mistakes which happen because of maybe lack of interpretation of the standard, or maybe they did not know what journal entry to pass. Workings were wrong in many cases. So I thought that we could probably use this as an opportunity to tell the members that they need to take a little bit more care in terms of these journal entries in IND AS, because end of the day, whether it is IND AS, whether it is AS, whatever it may be, we will ultimately have to pass a journal entry. Whatever be the accounting standard we do, end of the day, journal entry is going to be something which is going to be a part of our, the way we implement these particular standards. So we thought that we'll start with this program. As Srinivas was rightly saying, 2 hours is rather insufficient to, go into all the standards and give detailed journal entry. So what I've done is that I'm going to give you a sort of a brief overview of main standards and how those journal entries have come in those standards, along with a few of the workings also. And of course, the presentation will obviously be with the branch, so you can also look at the presentation and look at it. And you can also go through it in detail. The other part of the workings, which I should say this because it's directly linked with your documentation standard, SA 230 on documentation. Whatever audit we are doing, the Ind AS journal entries which are a part of your workings also should definitely be a part of your documentation. This is something which I'm not saying has not been done, but we need to sort of, give a little bit more importance to the documentation aspect, because many a time only the journal entry is passed, the documentation is not done. So I leave you all with that particular, thought process. Okay. Why this session? I've just given you a brief background. See, this is the normal flow of an accounting standard. Ind AS standards, you have a scope of the standard. You've got a recognition, which will be initial recognition and a subsequent recognition. Measurement, again, initial and subsequent will be there. Derecognition assumes a lot of importance in Ind AS because of the fact that many of these items which have been recognized will also be derecognized, and that's where the journal entry comes in also. Disclosures is something which we don't have to too much worry about, because there's no journal entry as far as disclosures are concerned. We only have to keep disclosing whatever is disclosed. And I think in Ind AS, the disclosures are pretty detailed. To say the least, they are pretty detailed. Just forgive me for a little bit of the coughing also because of some issues with the problem. Okay. So where will your journal entries come in here? Always only recognition, measurement. That is where your journal entries will come in here. Recognition, measurement, that's where most of the journal entries which we are talking about will probably come in for the Ind AS standards. I have not covered many of these standards because these are basically disclosure-based standards and they do not require any journal entries. We'll pass them because though presentation of financial statements, you may have a requirement for passing a journal entry for other comprehensive income, but we will come to that when we look at the presentation of financial statements. One of the first things I wanted to tell you all is that we have got this thing called as other comprehensive income. In shortened terms, it's called as OCI. One of the things which you all should learn when you all, for those of you who are going to be familiar with Ind AS, is that you should start learning abbreviations. Don't say other comprehensive income. You say OCI. Don't say statement of changes in equity. Say SOCI. That gives you don't say property, plant and equipment. Say PP. You see, the Ind AS becomes a little bit more interesting if you start using these shortened forms of this thing here. Now, what we have found in many cases is that, especially the people who are implementing Ind AS for the first time, you tell them that OCI is a separate account, and it is a sort of a curiosity. Because in India, what has happened, OCI is a part of your P&L account. Abroad, it is a separate statement. In India, it's a part of the P&L account. You have net profit as per profit and loss account, and then you have items of other comprehensive income. Now, what Ind AS 1 has done, it has specified clearly what can go into OCI. Those items are on the slide here, but I'll just give you 2 or 3 examples. Changes in revaluation surplus. Please remember, it is only changes in revaluation surplus. It is not revaluation surplus as such. Revaluation surplus goes back to your revaluation reserve and property, plant and equipment or whatever is being revalued. Only changes in the revaluation surplus will hit your other comprehensive income. Similarly, actuarial gains and losses. They've got a better term for it. They call it as remeasurement of defined benefit plans, which is nothing but actuarial gains and losses. Foreign operations and some lot of financial instruments, which are there as a part of your other comprehensive income. Now, why I have mentioned that OCI is not a ledger account is because many a time we see that when we are passing a journal entry, debit side, there is absolutely no problem. We will say, sir, debit PPE, sir, no problem, because it could be a revaluation surplus, it could be any impairment also, no problem. We will debit PPE. When we ask them what to credit, they will say OCI. Because they don't know where that other credit entry has to go. By default, many people, company people, I'm not talking about the chartered accounts, company people say OCI. So they've made OCI into a ledger account. It is not a ledger account. OCI is nothing but an extension of your profit or loss account. It's nothing but an extension of your profit and loss account. So whatever the components are there, only that can go as a part of your other comprehensive income. This is the first part. Second part is, apart from what has been mentioned here, nothing else can get into other comprehensive income. This is something which is, I mean, though it is not a part of your journal entry, but please ensure that only if you have these items can they get into your profit or loss account, get into your other comprehensive. Otherwise, it will either be a P&L account or it could probably be adjusted in your balance sheet itself, other equity. It could be possible that it could probably be a other equity. For example, why is this other comprehensive income required? This is a general discussion. Why is the OCI required? You look at the components of OCI. You look at the components of OCI, all of these components are actually not realized gains and losses. They are actually notional gains and losses. So the purpose of other comprehensive income in Ind AS is only for the purposes of protecting your P&L account. Even your earnings per share, EPS, is calculated on the basis of net profit, not total comprehensive income. So the purpose is only for the purposes of protecting your P&L account, because you can have fair valuation, you can have a lot of changes. Actual gains and losses, there can be a lot of changes. Those are notional losses, not realized losses. Obviously, once some of these losses are realized, they will flow back into your profit. It's called as recycling. It will recycle back into your profit or loss account. So these are things we have to keep in mind. The other aspect of OCI, which is important, not captured here, but I should tell you all this also, is that any deferred tax impact and forex impact of components of OCI will also be a part of OCI only. You cannot put deferred tax for revaluation surplus, changes in revaluation surplus in the P&L account. Deferred tax and forex gains and losses of components of OCI will be a part of your OCI only. Some other things which I thought I should tell you all this. This is more a general discussion. Which is the best accounting package for Ind AS? We normally get this question asked very, very frequently. Any choices? Any of you want to take a hit at answering this question? Pramod? Left hand side, all famous things are there. Intuit is there, Oracle is there, SAP is there. What do you think is the best accounting package for Ind AS? On the right hand side, prominently I put Tally Prime. Only because I couldn't get a smaller version of Tally Prime, that's why. Not for any other purpose. What do you think is the best accounting package for Ind AS? Or is it none of this is applicable? If you look at how Ind AS flows, you look at any ERP package, you will get a normal trial balance, probably normal set of financial statements. But you look at the concepts in Ind AS, you look at the concept of fair value, you look at the concept of impairment. Many of these are going to come out of the books of account. You will not, you can probably feed in the values into SAP or Oracle Financials or probably, any other accounting package, but you will not be able to generate the entry in any of these packages. So to a limited extent, all these packages will throw you a Ind AS formatted profit and loss account balance sheet. It will not be an Ind AS valued profit or loss account and balance sheet. Valuation always has to flow from outside. Those calculations have to be done outside only, and that calculation will flow into your SAP or whatever it is. But of course, not in Tally Prime, but earlier when Tally was there, I always used to make this comment that Tally is the best accounting package for Ind AS because of a very simple feature which they had. They had a very nice feature called as Alt-D. As long as that feature was there, it remained one of the best accounting packages because you value something at cost. You want to fair value it. What will you do? Alt-D, put the fair value, you are done. There is no need to reverse the entry, ask for approval in SAP. That person will be on leave. He will not come back for 15 days. That entry will get held up. Because of the user friendliness of Tally, it remains a package which can be very easily, conveniently adapted for Ind AS. We should also remember that Ind AS gives you a lot of opportunities for estimates and judgments. My estimate can change. My judgment can change on a year-on-year basis. we require an accounting package which is flexible enough to capture those benefits. And I still feel that Tally, with all its user-friendly features and everything, is probably best suited for Ind AS. Other packages are good, I'm not saying no, but the process becomes a little bit more detailed to capture an Ind AS financial statements. Why are workings and journal entries important? Lot of notional entries come up in Ind AS. Many of you who have seen Ind AS financial statements will see. You'll have something called as finance cost. Nothing to do with bank borrowing at all. It'll be some security deposit is being discounted. Lease rentals, you will have something called as right of use asset and depreciation of that. The asset does not belong to me. It does not meet the definition as per asset, as per the framework also probably. But still, I'll be putting a lease liability. I'll be putting a finance cost of the lease liability also. The journal entries become very important because of the fact that you are pushing in a lot of notional entries into Ind AS. Anything beyond 1 year is discounted in Ind AS. Anything future 1 year is discounted, previous 1 year is restated. Only current year we have to put in Ind AS. That's why they say in Ind AS balance sheet as at 31st March 2022 means value of assets and liabilities on that date, not 1 day before, not 1 day afterwards. 1 day afterwards means discounted, 1 day before means restated. That is how Ind AS is looking at the concept of fair valuation and how those financial statements would, come out because of the fact that you will have to use this time value of money. So you will have a lot of notional entries coming up in Ind AS, which I think, if I may use that word, right, are very important and critical from the point of view of the last part, which is your tax implications. If you go and tell an income tax person today who's doing Ind AS assessment that I have taken depreciation on Xerox machine which does not belong to me, he's going to say why. Of course, in computation of income, you will disallow it and you'll show a normal operating lease. That's a different issue altogether. But the number of notional entries flowing in Ind AS is so large that assessments become a problem. Especially now, of course, I'm not here to judge on tax assessment and all, but all this faceless, nameless, blameless assessment, I do not know what is going to happen. We do not know who's going to assess me. Does he know Ind AS? I'm not so sure. Is he going to know what are those notional entries? We are not very sure. Both from the taxation point of view and from the documentation point of view. In fact, we tell a lot of our clients, if you are passing a notional entry, please put finance cost bracket Ind AS. Let it be captured as a finance cost which has arisen only because of Ind AS, not because of normal borrowing cost, because who knows, faceless assessment, they may actually allow it also. We do not know, though it should not be allowed. We never know about it. Then after 3 or 4 years, it will come back and hit us with, problematical situations. So this is why these journal entries become very, very important. You look at a normal process, how it is followed. For any company, you will get, and all of you being auditors, those who are seeing online also, many of you are auditors, you know the process. You get a set of financial statements. They will say that this is the first draft. It will not even be a draft. You will then have to pass your audit entries, which will be probably the second draft. And then you'll have to push in all your Ind AS entries. Who is going to keep a control of what are your audit entries, what are your Ind AS entries? Both may be together also. That is why this session on journal entries and also when you do this documentation standard, both become very, very critical. We have had situations in the past. Wherein Ind AS balance sheet has been finalized. I'm talking about 2-3 years back. Ind AS financial statements have been finalized. It has carried opening balance carried forward, next year also carried forward, everything has been done. But they found out an error in the first year's implementation itself. And in Ind AS, once you rectify, you go back to the past period, it becomes a prior period. You'll have to go and restate and all. Those complications will come into play. So that is why these things become very, very important. But I am probably going to say that we'll not worry too much about the tax implications because that's a battle we have to face any which ways. ICDS, for example, is nowhere near Ind AS. The total number of pages all the 10 ICDS standards are not equal to one Ind AS standard, Ind AS 109. If you look at the total number of 189 pages is there, Ind AS 109. ICDS probably 50, 60 pages maximum. So I think something we should not worry about. That's the battle we anyhow have to face. But what becomes important for us to understand is that because these concepts of Ind AS are, I won't say new, but slightly different. It requires some amount of convincing to convince the assessing officer that this is coming as per Ind AS only. We've had situations wherein questions have been asked about Ind AS accounting standards which you could not even answer also. From the tax department, I'm saying. We could not even answer those questions because such were the type of those questions, because conceptually things are very, very different here. So I think that is why we have to look at this from that point of view. I've just put in a couple of formulas. I'll come back to this in a bit of time just to show you all the formulas. This is a standard which required changing from a very long time. Revenue from contracts with customers. Ind AS 115, the standard. Now, all of us know this concept of AS 9 by heart. Many of you are probably new here, people are seeing online also. AS 9 gave us one brilliant sentence saying that transfer of significant risk and reward. That's all, over. Do whatever you want. The moment transfer of significant risk and reward has happened, you can recognize revenue. The problem in AS 9 has always been that it is an extremely short standard. It is only about, I think, 25 or 29 paragraphs long. Why am I saying this? Because businesses have become more complex now. You cannot have a 29 paragraph accounting standard only for a main concept like revenue. There's also a disconnect between other standards. Take, for example, AS 15 or Ind AS 19 on employee benefits. Important standard like revenue, 28 paragraphs, slightly, I won't say unimportant, but disclosure-based standard like employee benefits, some 120 pages, 20 paragraphs. There was obviously a disconnect. The International Accounting Standards Board, along with the Financial Accounting Standards Board from the US. See, US GAAP was always saying that we are the most powerful set of accounting standards because we are rule-based. Transfer of significant risk and reward is a principle. It is not a rule. When that risk and reward is transferring is a rule. It depends on the contract. That is why they said revenue from contracts with customers. So when the US GAAP and, the FASB and the IASB decided to say that, okay, now let us do one thing. Let us formulate one common set of accounting standards. Because US GAAP only for revenue recognition. Only for revenue recognition. They had an earlier standard called as SOP 97/2. That itself went into some 200 paragraphs. Only for software revenue recognition. So one of the first standards they revised was the Ind AS 11 and Ind AS 18, which has now become Ind AS 1151, revenue from contracts with customers. The title of the standard itself says that it is focusing on the contract. It is not focusing only on the revenue. Ind AS 11 had something called as the percentage of completion method. That also said you have to do a POC method based on stages and all you can do. But there was one more shortcoming in that standard. It did not tell when do I commence it. It said POC method you do, but never said when do I commence my POC method. 25%, 30%. It came in because of a guidance note from the ICA. Because of an ICA guidance note, we started commencing on this 25%, 20% of revenue to be collected and all those things. What this standard has done is that it has completely changed the concept of revenue recognition based on some 5 steps. We'll go through those 5 steps and all in some other session, but the most important word here is performance obligation. The entire weight of Ind AS 115, if I may use the word, the most critical part of Ind AS 115 is based on this concept of performance obligation. Performance obligation means what an entity has promised to perform in a contract. It can be warranty, it can be service, it can be free upgrades. All those things become a part of your performance obligation. Because of the focus on the word called as performance obligation, it becomes extremely important that at contract inception itself, we understand what is the performance obligation. I mean, we have to identify what are the performance obligations. Some may have to be deferred, some may be done at a point in time. So that is why the standard becomes very, very important to understand. And just as a side effect, I'm telling you, side matter, this is nothing to do with the journal entries. Most of the key audit matters, at least if, in my opinion, at least in about 80% of the companies, key audit matter has always been Ind AS 115. You take all the large companies also, they've always mentioned Ind AS 115 is a key audit matter. There is nothing wrong in that. There is nothing wrong in that. When do you put a key audit matter? You put a key audit matter when you feel that there is some risk in that and how you have handled that risk. That is how a key audit matter comes into play. So I believe that many people are still feeling that there is a little bit of risk in Ind AS 115 because estimate, judgment, performance obligation, probably we have not understood this completely. So as a matter of abundant precaution, put it in your key audit matters. Over time, people will probably get used to this and sort of, understand what is happening here. This is my first journal entry. Don't worry about the narrative part. I'll just give you explanation because small audience, I can explain to you very easily what it is. This is unlike in the Indian situation, but I put CAS because I knew that Srinivas will not be here during the session. I wanted to put his name, but I knew as chairman, he'll probably go away. The very popular example, this is. It's very common in UK and other countries also, in Europe and all. India, what do we do for India? We go and ask for a mobile connection. There, it's a contract. You can go to AT&T and tell them that I want to get into a contract with AT&T. He'll say which phone you want. Depending on which phone you want, he'll give you a contract. You want iPhone 13, he'll give you one contract. So basically what happens abroad is that you get into an agreement with the service provider, you get the handset free of cost. Depending on which handset you want, he gives you a package. He'll with a package, but it's nothing to do with the handset. There's a difference here. There are two performance obligations which are very, very clear. One is definitely sale of the handset, because without handset you cannot operate the phone. The second is whatever service obligation you have got into with the telecom operator for, let us say, 1 year, 2 year, 3 year, whatever that contract is. I have given in this example a 1 year contract. 100 rupees per month, 1,200 rupees per year. In that, what is he saying? He is saying that I'll give a handset free of cost. They've also given some numbers saying that the handset is valued for a standalone selling price. You get this as a standalone selling price, and service contract also some standalone selling price is given. 300 rupees and some 80 rupees per month without the handset. So if you just look at this number here, 80 rupees per month into 12, 960 rupees is my service contract for a standalone customer, not for this particular transaction. 300 rupees is your cost of your handset for a standalone person. So 1,260 rupees is the total cost. He has given it to one person for 1,200 rupees, which means based on that allocation or based on the standalone selling price, we will have to do an allocation, which is what I have done here. I have done this allocation of, I get 286 rupees and 914 rupees. Simple Excel formula based on that 1,200, 1,260 into 300. I have got these two figures and I get the standalone selling price of the handset at 286 rupees and the service is at 914 rupees. The journal entries are very, very clear. The journal entries are that contract asset debit 286 rupees, credit handset revenue to 286 rupees. Monthly, I will keep on amortizing this amortization of this trade receivable, and the revenue from services also keep on adding every month here. So because this is a 12-month contract, total amount of services will be divided by 12 every month. As and when we are recognizing the service, will recognize the revenue. As far as handset is concerned, I already have the handset with me, physically delivered. That revenue is recognized. Contract asset is there. That amortization will happen over a period of 12 months. These are the complications which Ind AS 115 has introduced. Please remember that the moment control has transferred, I can recognize revenue, which means physically I've got the handset. My only obligation to the service provider is to ensure that I continue the services for 1 year. And this revenue recognition from the point of view of the service provider, not from the point of view of the person who has received the phone here. So that's why these things become very, very important. A few other complications in this Ind AS 115, right to return. This is a very popular concept, especially in these e-commerce companies. 30-day, if you don't like, after 30 days, you can return the goods. Because there, nowadays people have stopped it because they become very smart now. They've said that, okay, in India, what is going to happen? 30-day return offer, people are going to buy it. 28th day, it will be returned. Because they will say 28 days it was very good, then 29th day, suddenly size will not fit. Or some problem will happen there. But look at it from the point of view of the entity who is doing this. They have physically given the goods and the person has got a right to return the goods. Let us say over some whatever period of time. I think he's got 30 days mentioned here. The Ind AS 18 was not very clear on this topic. 115 has introduced a very specific clause on the right to return, saying that you make an estimate. You make an estimate of the right to return. This is where 115 is starting to talk about estimates, judgments, and all those things. In this particular example, they have given an example of saying that, okay, 3 products will be returned. And they have passed the necessary JVs because 3 products are returned means 9,700 rupees revenue. 300 becomes contract liability because I have got an obligation to not get revenue from that particular 3 products. It becomes a contract liability. And of course, there's an equivalent debit to the cost of sales. And because it comes back, it becomes a part of my inventory. These are all very normal examination type of examples given in your Ind AS standards here. The concept of contract asset, which I showed you all earlier here, and the concept of contract liability are completely new contracts. In the in the previous gap, we were probably calling it as advance from customer. That becomes a contract asset and a contract liability now in Ind AS, because contract asset and contract liability would definitely have to be adjusted depending upon how you are performing in that particular contract over a period of time. That is why this becomes an important part of your discussion here. So this is what I mentioned here. Another completely new concept in Ind AS, I have just used the word called as SFC. The expansion goes as significant financing component. Again, this requires for the normal accountants in us, this becomes a very difficult concept to understand. Because what Ind AS 115 is saying, again, they go back to the concept of substance over form and all these terms which are being used to describe the Ind AS standards. Suppose your customer has in effect financed you for the purchase of his for that particular transaction, for him to purchase goods from you. You are selling goods to him. He has effectively financed you. The most popular example given is that there's a product which is being delivered or which is being manufactured. It has got a 2-year to manufacture. Only then SFC will come into play. It has got a 2-year time frame, before you will actually be able to deliver the product to him. You are giving the customer two options. Pay some money right now in full consideration of the contract, or pay some money at the end of 2 years, or whatever the consideration. Obviously, at the end of 2 years, it will be slightly on the higher side. Assuming the customer has chosen to pay you in advance, that is, he chooses the option of paying right now. IND AS 115 says that effectively he has financed the transaction. He has financed the sale, so add in an element of significant finance component, which means that in the example I'm just going to show you all, I'm going to say that 4,000 rupees has been received in advance. Option is 4,000 rupees now or 5,000 end of 2 years. He's choosing 4,000 rupees now. Standard says that you will have to put in a significant financing component, which means that there will be an interest which will be accounted for. You can see what has happened here. The initial cash received will become a part of your contract liability, because we should wait for 2 years. We don't know what is going to happen in 2 years' time. I may have to cancel the contract also. So it's sitting in my books as a contract liability. I am putting in an interest expense. The reason why interest expenses come in is because of the 6% interest rate. That's why interest expenses come in here. And the total contract liability becomes 494. End of the second year, assuming everything goes as per the plan, you are able to deliver the product, goods are shipped to him, everything happens. End of the second year, you will reverse your contract liability for 4,494. You will recognize revenue for 4,494, out of which effectively 4,000 is revenue, 494 is interest income. Again, notional interest income. You can break it down into this thing here. I am not going to get into the taxation and GST aspects of this, because this is going to be a separate session by itself, but you can definitely expect questions to be asked. I got the money in advance, so I do not know whether it's going to be, it will be considered to be a supply or all that. I do not know. All that the GST experts will have to probably answer that question. Purely from the IND AS point of view, I am recognizing 4,494 as my income. How much have I received? 4,000. What is 494? Notional interest income. Is it taxable? I do not know. GSTable? I do not know. But from the point of view of IND AS, this comes in. So that's why I repeat my earlier sentence saying that please document all your IND AS notional journal entries. There will be a important thing to notice in this, because lot of such entries keep flowing in your IND AS financial statements. The other thing which I will explain to you all, and this is something which is important in, especially, in large oil companies, oil mills and all those things, is something called as decommissioning cost. It's also called as ARO, Asset Retirement Obligations. Again, same concept only, but discounting here. Even though I told you IND AS lives on a year by year concept. Every year they have to revisit your financial statements and all those things. For decommissioning costs, they have got a slightly different accounting treatment. I'll tell you first of all what is decommissioning cost, and then you can look at it from the point of view of practicality. Let us say that the government gives you a permission to build an oil plant somewhere near Mangalore. And they say that you build the oil plant, you run it for 25 years. End of the 25th year, you give back the oil plant to me, not the oil plant, give back the land to me in the way in which I gave it today. Which means that I gave it to you as an empty piece of land today. End of 25 years, you please give it back to me in the same condition. Which means I have to decommission the plant. I have to decommission the plant means I have to bring down whatever I considered over the last 25 years. Which means that there's going to be a cost. IND AS has a very unique way of handling this. What they are saying is that you estimate what is going to be the decommissioning cost at the end of 25 years, and provide for a liability from today onwards. Which means that suppose at the end of 25 years, on a very broad basis, you're saying it's 25 lakhs of rupees. Provide 1 lakh of rupees every year. So at the end of the 25th year, what is going to happen? You will have a liability sitting for decommissioning cost of 25 lakhs of rupees. When you actually decommission the plant, that liability should be there in your books of account. For the initial entry alone, this first journal entry alone, you debit your property, plant and equipment. Debit property, plant and equipment, keep on adding it as a finance cost subsequent years, and end of the 25th year, you should have this decommissioning liability of 25 lakhs of rupees. Of course, the estimates can change. All that will, those things can always happen. That will also adjust to your finance cost only. Very interestingly, what is going to happen is that, how do I know how much of money I'm going to spend at the end of 25 years? That also they have a solution. They say, okay, doesn't matter. You see what is going to cost today to decommission the plant. You add in a factor for inflation. You know what it is going to be at the end of 25 years. Discount to present value, you get today's cost. So basically, if I'm using the same 10%, I'll get the same rate which I'm doing today for 25 years. I said 25 years. Maybe too long. You take a simple plug and play office operation, 5 years lease. It will apply there also. The lease agreements for all these plug and play operations are something called as, it will be given back in broom clean condition, which means that if I clean it with a broom, nothing should be there. There also I could apply this, because I may have to decommission that plug and play operation, I may have to incur a cost, I may have to do it there. So here you can see that you have got this entry here, wherein you're putting the compound interest every year, and the end goal is to ensure that you get 500,000 rupees provision at the end of the 5th year. In this particular case is 5th year, but depending on the term of the lease, you have to do this decommissioning cost. I will repeat again that initial entry, I'm debiting PP. Initial entry, I'm debiting PP. All of us have heard of this classical concept. What do you capitalize? We capitalize all cost incurred to bring the asset to present location and condition. This is nowhere near that. I'm not incurring this cost. I'm estimating this cost. I don't know if my estimate is right also. But I'm adding it to my PP. And not only adding to my PP, I'm also depreciating it. So those concepts of matching concept and all those things, all that you have to park aside now when you're talking about IND AS, because there's no concept of matching concept here. This is a cost which is a completely notional entry. Suppose the government says, I don't want this, keep it with yourself. What happens to this cost then? It will just be capitalized in my books of account. It will just be depreciated, though I don't actually incur this particular cost. So some of those nitty-gritties we have to worry a little bit about, but it is important that we know that the decommissioning does not necessarily apply only to large contracts. It also applies to a small contract wherein you have to actually give this thing here. Financial instruments, I'm just going to talk a little bit about, because this is a very vast topic by itself. Just a few things I'll tell you all about financial instruments, because this standard is one of the longest standards in IND AS. Longest means in terms of length. And many people who start reading the standard will forget what the standard is talking about by the time you go to the end of the standard. Though you have got basis for conclusions, you've got examples, all those things have been given there. Now, basically, we had a problem in this earlier classification. See, one of the problems we faced in India, just to give you all a bit of the background on financial instruments, was that in India, AS 30, 31 and 32 was never made mandatory. It was always only recommendatory in nature. And we all know very well happens. If there's a recommendation, what will we do? Let it remain a recommendation. What is the guidance note supposed to be meant for? Guidance, that's all. Needn't follow it. So AS 30, 31, 32, which was based on the previous IAS 39 to a large extent, was always recommendatory in nature. The International Accounting Standards Board was facing a lot of criticism because of this IAS 39. They were saying such a complex standard. Why do you want to make it so complex? They had one concept called as HTM, held to maturity. They said held to maturity financial instrument can be at amortized cost. No need to do a fair valuation. The other categories were available for sale, held for trading, and one called amortized cost also. I mean, people who have done bank audits will remember this is exactly how treasury of banks also operate. Or the classification, RBI classification, even today is based on the same concept. The problem came up because how do I prove my intention of holding to maturity? I show it at cost. If I do one transaction, it becomes available for sale. I have to do a fair valuation. Intention was driving the classification there. Intention could change. Especially after this mortgage crisis in the US, wherein all loans which were given, housing loans which were basically given, were obviously they are saying held to maturity because I'm waiting for that person to give it back to me and all those things, whatever collateralized agreements they had. So they decided to change the standard. This was a very interesting phase for India. What the International Accounting Standards Board did was they changed the IAS 39 in 4 stages. They didn't do it immediately. And as a result, what we have today is a standard which is probably a bit more complex than what the old standard was. They are saying business model would drive classification. Measurement, recognition also based on business model. They are saying something called as SPPI test, solely payment of principal and interest. In that case, it is a amortized cost, otherwise it becomes fair valuation. So the entire standard is depending on what the management or the entity feels is their business model. A typical NBFC which is giving housing loans does not sell those housing loans to other third parties, can do it cost only, no need to do fair valuation. So when India transitioned to Ind AS in 2015, we were in the middle stages. 2-3 phases of IAS 39 already done. 4th was only impairment was left. Ministry of Corporate Affairs had a challenge in front of them. Should they adopt Ind AS 109 or should they adopt IAS 39 and then, bring on Ind AS 109 later on, because there was a 2-year window for you to actually implement Ind AS IFRS 9 also. But for whatever they prevailed, they said that, no, let's not worry about this because we'll straight away go to Ind AS 109. So to a large set of entities in India, what has happened with absolutely no exposure to AS 30, 31, 32, they have straight away got into Ind AS 109. If you look at the transition adjustments, Ind AS transition adjustments, financial instruments implication has been the maximum impact because we did not have an erstwhile standard which we were actually implementing at any point of time. In that context, this standard assumed a lot of criticality. Even today, it's assuming a lot of criticality. The Reserve Bank of India has continued with their classification norms. They don't have any, guidelines as such on Ind AS. They had some committee which has given some report. But as all of you all know, banks and insurance companies are 2 sets of entities who have not transitioned to Ind AS even today. RBI is waiting for IRDA to come out with an announcement. IRDA is coming out with waiting for RBI to come out with an announcement because IRDA we can understand because a new IFRS 17 has come, Ind AS 117 has come, applicable only to insurance companies. So maybe they are waiting for that to become mandatory and then they will implement it. But in the present day and age, I think the difference between a bank and insurance company is very, very little actually. To take for example LIC is 50% insurance company, 50% bank. So financial instruments will come there also. There also will become very, very important. With this background, we should remember that the criticality of Ind AS 109, I'll not worry about Ind AS 32 and Ind AS 107 because they're only disclosure-based standards. Ind AS 32 has got something called as a compound financial instrument, which we will see in a little bit of detail. This standard has troubled a lot of people who have implemented Ind AS. When I say troubled, I mean in terms of trying to, because as I told you all, we did not have a previous background. We straightway jumped into Ind AS 109. So you see this compound financial instrument, I'll just give you all a very simple explanation here. Convertible bonds, convertible preference shares, all these things. We had a concept of equity shares, preference shares in the Indian context. India has only equity shares. You cannot have preference shares. They have something called as equity share. Their classification only equity share capital and other equity. You don't have anything in between. Now, of course, you've got something called instruments that are entirely equity in nature. If a compound or if a convertible bond is convertible into preference shares, compulsorily convertible into preference shares, and the ratio has been fixed, Ind AS 32 says it's a compound financial instrument and says split that between the equity and the debt portions, debt portions right now. First calculate the debt portion, the rest will become your equity portion. Only they have this concept called as fixed for fixed, means if the amount has been fixed. Of course, the amount has not been fixed, it does not matter, it will probably remain as a liability only. So in that context, we've got this particular, I've done the present valuation for this particular thing, for this coupon. 7% is the interest rate we've put in here. The 50 lakhs is the proceeds. I've done the present value, including the 52 lakhs cash flow end of the year 5. I got 43 lakhs to be the present value, which means that the present value of what is this 52 lakhs here, cash flow, interest and other cash flows. Present value 43 lakhs, total amount received 50 lakhs of rupees. Ind AS says liability is 43 lakhs of rupees, your balance is 6 lakhs of rupees becomes your equity capital. So you can see here, they'll say liability will be convertible bonds 43 lakhs of rupees. Credit equity of convertible bonds at 6,15,000 rupees. As the liability is being paid off, it will be settled. Equity will remain in equity only. At the time of conversion, suppose there is a premium or a discount, that will be adjusted accordingly. One of the major changes made in Ind AS is something called as ECL model, expected credit loss model. For those of you who are listening online and those present here also, this is a completely different change from what AS has taught us in terms of impairment. AS was working on something called as incurred loss model, which means that you wait for the loss to be incurred, you wait for the loss to be quantified, you wait for the loss to be determined, which is basically a function of time. When I'm saying it's a function of time, I mean that, okay, 1 year, 2 years, 3 years, you wait. Please remember that this is applicable both to financial instruments as also trade receivables. I'll come to trade receivables in some time. All financial instruments, intercorporate deposit given 3 years back, not repaid as on today. You will slowly say, in the AS world, you have waited for some time, function of time. End of the 3rd year, maybe make a provision for 30, 40, 50%. Ind AS says expected credit loss, which means that how much do you estimate will go bad in this? You can see how aggressive Ind AS is becoming now. Purely management estimate. Okay, they will obviously be having some past record, they may have some data and all those things, but still it remains an estimate. On the basis of the estimate, impairment allowance is debited to the P&L account always. My profit and loss account takes a hit and my asset also gets reduced. You can see how difficult this becomes. So I have given the formula here for expected credit loss. It is called as EAD into PD into LGD. I'll explain this. I told you all, get used to abbreviations in Ind AS. EAD means exposure at default. PD means probability of default. LGD means loss given default, which means that suppose I had 100 crores of credit card portfolio. Bank has got 100 crores of credit card portfolio today, as on date. Exposure default is 100 crores. Probability of default, let us say 5% of my credit card customers do not pay me. I'm just giving you a very broad example, but you can use it for the purpose of getting to why this ECL model becomes important. 5% don't pay me. That is my probability of default. If these 5% don't pay me, how much do I lose? I lose 30% of my total credit card portfolio. So 100 into 5% to 30% becomes your ECL provision year on year. And of course, just like in all the other Ind AS standards, even this standard says, please review your ECL provision year on year. Because in 1 year, things may have obviously changed. You may have had better recoveries, you may have had worse situations and all those things. So please review the ECL provision which is made year on year basis. On that basis, you make a provision for your expected credit loss. So it is a little bit more, shall I say, aggressive. What will happen in Ind AS because of this ECL model? Two things are going to happen. The amount of credit losses recognized will be more in most of the cases. They will also be recognized earlier. Many of you who are probably going to attend the bank audit seminar, which the institute is organizing next month, please keep this in mind. When you go to a bank audit and you try to put in this ECL model in the branch, I mean, this is almost like futuristic thinking, but just imagine, basically what Ind AS is saying in a very indirect manner is that the best person to decide how much to provide for a loan is the person who has given the loan, not the Reserve Bank of India, not any regulator. The ECL model is working towards that concept. You can probably expand the same concept to useful life also. Best person to decide useful life of an asset is not Ministry of Corporate Affairs, not Companies Act Schedule 3 or Schedule 2. It is the person who bought the asset. See, Pramod has got a new phone today. He knows how long he's going to use it. I cannot tell him to do depreciation for 4 years. He has bought it, he is going to use it, he can depreciate it. I mean, based on the useful life. The Reserve Bank of India, luckily, thankfully, in their committee report, and this will be useful for those who are also online and probably want to do this bank audit. The first committee report on Ind AS has said that the IRAC norms will be the basic norms on which you have to provide for bad debts. But in case you want to provide more, please use the ECL model. I do hope that recommendation comes into practice, because all your bank audits is going to become value-added audits, because you're going to keep on saying ECL model, keep on adding more provision based on what estimate has made at the branch level on, I won't say one class of loans, but all class of loans, substandard, standard, doubtful, everything. You have a track record, you know how much has gone bad, provide for it. It may be difficult to implement because of the fact that, considering the fact that, they'll always come back and say, no, sir, collateral is there. They'll always say, last day when credit has come into the account, it's gone into IBC. They'll give out all these reasons and excuses, but I'm still saying that definitely, if you look at it from the point of view of Ind AS, this is definitely going to happen. And provisioning also will become faster and higher. The good thing about the Ind AS standards is that they not only ask you to provide faster, you can also reverse faster. Apart from goodwill, apart from impairment of goodwill, any other impairment which has been debited to the P&L account can always be reversed back. If you feel that conditions have improved, recoveries have happened, whatever impairment loss in the ECL model you have done can always be withdrawn back. So it goes on a year-on-year concept. Depending on what has happened in that year, you all will do these particular entries here. So I've just given this example for this. The other part of Ind AS, which is probably got a lot of attention of everybody, is this concept of leasing. Now, as accountants, all of us know one thing, only two things: operating lease, finance lease. This is what we know. We've been trained for this from a very long time. And we also know that definition of operating lease, that if it is not a finance lease, it's an operating lease. Operating lease has never been defined anywhere. Negative definition. I will go to the standard and see what are those 5 tests. Does he give me possession at the end of 5 years? No. The fourth bullet point in that says that if the present value of the lease payments is almost equal to the fair value of the asset, then it becomes a finance lease. fair value not defined, present value not defined, discounting rate not defined, how much that percentage should be also not defined. The standard just gave a comment saying that if the present value of the lease payments is almost near to the fair value of the lease, it will become a finance lease. Finance lease means, okay, again, depreciation, asset in the books of account, for whom it's only a receivable, all those accounting entries are there. Thankfully, what happened was that the operating lease was defined negatively. So my only test we had to do was to check whether that meets the definition of a finance lease or not. If I change the discounting rate, it can become a finance lease. If I change the fair value, it can become a finance lease. So the leasing standard had this sort of a problem because most of the leases which met the definition of an operating lease were going and being debited to the P&L account. Only those which strictly met the concept of finance lease were coming in the balance sheet. International Accounting Standards Board, when they started revising these standards, and they kept substance over form and all those things, they said that the fact that many of these leases, which are intricately linked with assets, and the assets are not coming in the balance sheet, is a problem. This is what they felt. So they said that when a person has got the right to use the asset, please remember, only right to use, not control. I have a right to use the asset. When a person has got the right to use the asset, that right to use itself can be quantified and brought into the financial statements as a right of use asset. When they proposed this, there was obviously a lot of negative feedback. They said, why you want to do all these tricks here? It is Aram say going in operating lease, let it remain there only. Why again bring ROU asset, lease liability and all those things? In fact, the previous chairman of the International Accounting Standards Board was asked this very question in some seminar. They asked him this question and said that, why do you want to complicate leasing so much? Anyhow, I don't own the asset. It's not my asset, it's somebody else's asset. I'm paying him every month. I'll debit it to my P&L account, go no. Why do you want to complicate the leasing standard so much? His response was very different. What he responded was, he said that, one day I want to fly in an airline which shows the aircraft as asset in the books of account. This was the response he gave, because most of the airlines are on leases. So that goes off in the P&L account as an operating expenditure. But you can see that airlines are operating such a big aircraft, not coming in the balance sheet. So his response was that I want to fly in an airline which shows the aircraft as asset in the books of account, which means that I will have to use right of use asset. They started the standard by saying that they did not think of the word called ROU asset at all. They said, I will first think of what is my obligation towards that person, my lease rental. They said, okay, I have got a non-cancelable lease agreement for 5 years. No problem. There's an escalation clause also. No problem. I will discount those to present value. Just like your decommissioning cost. I discount to present value. I have got the present value of an obligation which I have to incur towards that lease over the next 5 years. If I keep on adding the interest cost, end of the 5th year, my lease payment will be 0. And then they thought of this. Okay, if my lease liability is 3,50,000 rupees, what should be my debit? And even though the framework for IND AS talks about the word called as control of the asset, they said that let's disregard the framework for a moment and say that for that 5 years period of time, I have got a right to use that asset. We will call it as ROU asset only. We will call it as right of use asset or right for use asset. We will show it as ROU asset. And we will show this entry which will start from the lease liability and end up being a lease liability credit, ROU asset debit. Basic fundamental accounting entry for leasing Please remember where we are coming from. We are coming from the fact that I have an obligation for a lease rental. I'm starting from that. I have a non-cancelable lease period. I'm adding that into account. I have a lease escalation also, which I'm reckoning also. I get the present value of my lease payments. It comes to me as a lease liability. That amount also becomes my right of use asset. Of course, I can have a possibility. I've just given a very simple calculation here in which I have said that you have got this discounting factor by doing that formula which I showed you a little bit earlier. With an escalation clause also, you are getting a 12,71,045 present value of lease payments. Assuming that this is a lease of a machinery. Just to give you all a flavor of how this entry will come in. Assuming that this is the lease of a machinery, my initial entry should always be ROU asset debit 12,71,045, credit lease liability 12,71,045. But let me pause for a moment there and tell you that in case you are incurring any costs, for the purpose of, let us say, improving that asset, or maybe installation commissioning cost, maybe a major cost towards maintenance, those costs can be capitalized as a part of ROU asset without touching the lease liability. So for all practical purposes, your initial entry is always going to be debit ROU asset, credit lease liability, but they need not be exactly the same, because it is possible for you all to increase your ROU asset by adding on some costs which are a part of the ROU asset costs or not incurred for the lease liability costs. Only for the asset, those can be capitalized. So strictly speaking, ROU asset and lease liability should be the same, provided you all don't have any additional cost to incur for the ROU asset, any of those costs which are going to improve the value of the asset. That as a basis, I have passed this journal entry, debit ROU asset, credit lease liability, and this table becomes very, very important. What I have done is that a lease liability balance, I have added an interest cost, and the payment of the lease rental has been captured here separately. The entire amortization table for leases depends on the fact that at the end of the 5th year, the balance should be 0. That's how this table should operate. End of the 5th year, the balance should be 0. Therefore, I will use that as a basis and say that this is my entry for, so my interest payment, again, I told you finance cost. I told you all finance cost, debit finance cost again for leases, put IND AS again separately there. All are still notional entries only. I'm not going to incur any of those costs here, but notional entries just to ensure that end of the 5th year, my lease liability becomes 0. But as all of us are aware, in the concept of leasing, many things can happen. The standard uses something called as non-cancelable lease period, which means that a lease period which is, I won't say fixed, but for which I'm bound to pay those lease rentals. I'm bound to pay those lease rentals. 3-year lease period, 5-year lease term, the lease agreement will say this is a non-cancelable lease period. Suppose there's an automatic extension of the agreement without both the parties having to agree or disagree on that. That additional period also will be considered for the purpose of lease agreement. So 3 years lease agreement, again they say 3 years you can extend it without both the parties having to agree. It will again become a part of your, it will become a 6-year lease agreement. And this table will have to be done for 6 years basically. It is also possible that the standard uses the word called as lease modification. Lease modification means we have taken on additional premises at an increased rent. So old lease agreement has been cancelled or it continues and a new lease payment schedule has come into picture here. Then also the standard says what is to be done here. So you can see here what has happened basically is that they have agreed to extend the lease by another 4 years for 500,000 rupees per year. I do a recalculation again. We do a recalculation again for the 5th year. We get a higher lease liability. We get a higher ROU asset. That difference will be captured as ROU asset and lease liability. So whenever there's a modification, whenever there's a lease modification, which increases the, not only the value of the lease payments, but also adds on, say, additional premises, or we take on additional area, additional space. In that case, we pass this calculation entry. I will have to add on to my ROU asset the additional point, the difference between the new period and what was there earlier, that will go on to add on to my ROU asset and equivalent lease liability also. And that schedule will obviously, again, if you go back to the schedule, it becomes 0 at the end of the, here it is 5 plus 5 years. So 10th year, this will, lease agreement will become cancelled, or it will become 0. And you know, all these things have matched now. We will have to pass entries accordingly. ROU asset will be depreciated based on lease term. Lease liability will be paid off based on lease term. So you have on the asset side, you have a depreciation cost, and on the liability side, you have an interest cost. For those of you who are interested in the tax calculation of this, you should, I mean, obviously there will be a situation wherein you will disallow the depreciation, you will disallow the interest also. There is always going to be a difference between your operating expense debit and these costs. There will always be a difference. But of course, in the computation of income, since we are going to remove this, the tax impact of this need not be worried about. The last part is, this is a very interesting standard called as business combinations. And I think, according to me at least, this is one of the best, I won't say best, but most well-written standards in India. I shouldn't say best, because then I'll be comparing with other standards also. Very well-written standard because it has taken into account the intricacies of what happens in acquisition accounting. And this is more a standard which talks about, not about valuation. Valuation is obviously coming from a different perspective. In case an acquisition happens, what and all can be done in acquisition accounting, every possible area of acquisition accounting, this standard is sort of handled quite well. This standard came about again because of the fact that they had to think of accounting entries for what happens when there's a contingent consideration. What happens when, since India is talking about fair valuation, what happens in case there's a change in the fair valuation? So all these aspects. So what Ind AS 103, which is standard we're talking about here, says is that it is based on what is called as purchase method of accounting. Purchase method of accounting means I will mandatorily have to allot purchase values for each of the assets and liabilities. If I have that fair value of assets and liabilities, normally in the Indian context, we have got used to the balancing figure being goodwill. Normally in Indian context, we'll think of the balancing figure as goodwill, because we will have an acquisition price, we will have assets and values of those acquired entity. In the normal situation, we will take it as goodwill. Ind AS slightly departs from that. I'm just giving you this very brief example just to tell you all about this, I've given the example, I thought I'll give the example of Bharat Pay, because that's so much in the news now. Assume these are the financials of Bharat Pay. How much would you pay for this? I mean, if you look at the balance sheet, the value is not coming in here, but this is more from a valuation requirement. Turnover, I've said, is 700 crores. Loss is 1,400 crores, double the turnover. So there itself we are in for a major hit. But I'm going to give you this from two perspectives. One is how much would you probably pay for this acquisition? This is not coming from Ind AS, this is coming from valuation. Market method, they say, market approach. Norm for a software company would probably be 2 or 3 times the turnover. So let us say 1,700 crores turnover means it will be about 1,500 to 2,000 crores. But then we've recently seen in the newspapers that there's a lot of controversy about this company. We don't know what is going to happen. Balance sheet has got, balance sheet size they say, 323 crores. The balance sheet size is 323 crores. Let us say that the people who are valuing this acquisition have given a valuation of 1 year's turnover, which means that total acquisition price is 700 crores, which means that any company is acquiring Bharat Pay for 700 crores. We have got 700 crores to be paid as an acquisition price, and we have got 323 crores as the balance sheet size. That difference normally in AS will be considered to be goodwill. But for a minute, Ind AS says that don't make it as goodwill immediately. Just pause for a moment and think, why are you paying 700 crores for an entity which has got fair value of assets of 323 crores? It's definitely not goodwill. There's something else. It could be technology, it could be brand, it could be, know-how, it could be customer list, it could be any of these things. So what Ind AS 103 says is that you can recognize previously unrecognized intangible assets in an acquisition, which means the person who is acquiring Bharat Pay is going to think that, why am I paying this premium of 367 crores? Why am I paying 370 crores extra? Maybe it's because of technology, maybe because of customers, any of those brand, any of those intangible assets. So 103 says, value the previously unrecognized intangible assets, only after that the balancing figure becomes goodwill. So if I extrapolate the same for this particular thing, I find that we have given a valuation of 300 crores for brand and technology, which means that 77 crores is balancing figure for goodwill. I have valued the brand here. I have used brand or technology. I have given a valuation for the brand or technology, and the balance 77 crores becomes my goodwill. Goodwill tested for impairment every year. Impaired goodwill can never be reversed. Brand value tested for impairment whenever indicators of impairment are there. But if the brand value is impaired and it improves next year, you can always bring it back to the books of account. This is the major difference between what was previously being called as the pooling of interest method and what is there in the purchase method. The dynamism of this method has captured all the intricacies required for a business combination account. They have also gone to the extent of saying that in case you don't know the fair value of the assets right now, you put approximate fair values. 1 year, you see what are the actual fair values. In case there's any difference, adjust it to your goodwill account or the other intangible assets account. So they've gone to that extent also. The other part of acquisition accounting, which is very important from a perspective of present day trends, is that just to give you an example of this brand also, assuming the same was applicable to, say, for example, Tally. I'm saying Bharat Pay because it's all in the news now. Bharat Pay, how much is, I can tell you what is the brand value, you'll probably say nothing. But Tally, for example, if somebody acquires Tally, how long do you think the brand value of Tally will remain? We don't know. We can't say. They are saying Tally Prime, now then saying Tally GST. Tally is always going to be at the back of our minds. For us, it's always going to be there. There also, Ind AS 38 says indefinite useful life can be done. Not infinite, indefinite useful life can be done. So you can see here that it has captured all the requirements of a typical business combination, wherein I am also permitted to recognize previously unrecognized intangible assets in my financial statements. But nowadays, what is happening is that companies are becoming smarter. They are saying that 700 crores for Bharat Pay. I do not know next year Bharat Pay will be there or not. What do I do? So when the business combination is being negotiated only, what they will say is that they will say, okay, we will do one thing. I will pay you 350 crores today. I'll pay you 350 crores today. I have to pay you 700 crores. 50% will pay you right now, 350 crores. Depending on how those problems are being sorted out, I will pay the remaining 350 crores. What is called as contingent consideration, which means that I am giving you a consideration based on future events which may or may not occur, event-based transactions or event-based consideration which is paid here. In the case of BharatPe, I have given this example saying that suppose all the present problems are solved, I will pay you balance 350 crores. The present problem should be solved within 18 months. If they are not solved within 18 months, I will not pay you. What is called as contingent consideration. So here, the only entry which will change in the case of contingent consideration is my 700 crores of bank account. I am not going to pay 700 crores. I am going to pay only 350 crores. So the same entry I will change and put it as bank will be 300 crores. Contingent consideration as a liability. We will do. Why is this? Okay. Now it's coming. Okay. So contingent consideration liability will be sitting in my books of account for 350 crores. When that 18-month period happens, when that occurs, if it happens, I'll pay it off. If it doesn't happen, I'll write it back. Contingent consideration can be in two forms, either in the form of liability, which means bank account, I actually pay it, can also be share capital. If the acquisition is being paid for by shares, it will also be share capital. I can give my shares in exchange also, so it can also be as a part of my share capital here. This is, you can see most agreements being done today, most acquisitions being done today, always keep in account the fact that we do not know what is going to happen in the future. We will have some contingent consideration. Depending on how those events are panning out, we will either make the payment or not make the payment. That's something which is taken care of in your business combination accounting. The standard also goes on to say that apart from expenditure incurred for issue of capital, all the other expenditure will be expensed off. You may have, say, for example, valuation fees. You may have auditor's fees. You may have legal fees. You may have various consultants' fees. In a business combination for acquisition accounting, normally what happens, all those costs which are, all those fees which are incurred are written off to the profit or loss account. Standard only says that any costs incurred for the purpose of issuing of share capital can be capitalized. So this is a normal entry for what is called as business combination acquisition accounting. We will just twist the example slightly to look at the other perspective of this. Before we do that, we will just look at what happens here. That will be liabilities written back, obviously. This will obviously be liabilities which have been written back here. There's also the concept called as bargain purchase. Last part of business combination standard is bargain purchase, which means that in this particular case, you paid 700 crores for an entity whose assets were worth 323 crores. Just to swap the equation. You are paying 350 crores for entities who got 700 crores worth of assets. Which means we will have a problem in this journal entry here because we will not be able to know that all this fair value is obviously going to exceed it here. What IND AS 103 says is that it is called as a bargain purchase. Bargain purchase, credit will go to P&L account. Which means that you have got an asset for 350 crores. Asset is worth 700 crores. You cannot pass this entry because it is obviously going to increase. I mean, it will be a negative value there. So we will have to worry about what is to be done there. IND AS 103 says very clearly profit or loss account or other comprehensive income. It will be a part of other equity, not other comprehensive income, other equity, not profit and loss account. IFRS says P&L account. IFRS says P&L account. We are saying here other equity. It will not touch your profit and loss account. It will be part of other equity. What is called as a bargain purchase. Present situation, you can find a lot of places where you get bargain deals because people are wanting to sell off. They want to, pandemic has impacted them. They're getting bargain purchases. This is the reverse of what is called as business combination. wherein we do not have, I mean, the method is the same. Still going to be method is going to be the same. Wherein you're going to pass acquisition entry only because the value of the consideration paid, is lesser than the net value of the assets. Therefore, bargain purchase, therefore, other equity, not a part of your business. When you don't have to pass this goodwill and all those entries here, because obviously the values have become very, very different. This is the other part of your business combination accounting, wherein you are talking about contingent consideration, wait for that event to happen before passing the entry. It is possible that you may say 18 months, you may say revenue should go up by 50% or profit should go up by 25%. Most of these acquisitions are, the acquisition agreement takes into account all these contingent consideration factors. What is to be done, what is not to be done, what will happen in case this, this particular target has been met. In fact, if you look at share-based payments, look at the standard of share-based payments and look at the share-based payment scheme of many of these top companies. There's a link between the profitability and how much of options they get. There's a link between the share price and how much of options they get. So this also has an implication there, because obviously if those targets have been met, the acquisition price will obviously increase. But the standard is very, very clear that purchase of method like accounting is, is what is to be followed there. And they use the word called as acquisition date fair values, which means that the fair valuation should be based on what is your acquisition date. The share purchase agreement will normally have an acquisition date. It will have a closing date. In most of the cases, we will use that date as the date for the acquisition here. So this is what we wanted to talk about from the point of view of journal entries for business combinations. This standard has largely not been amended. Only recently they have made an amendment wherein they have said that we will have to distinguish between what is called as a business combination and an asset purchase. In many cases, I don't acquire the entire entity. I only acquire a significant part of the assets of the entity, in which case I don't have to follow IND AS 1 or 2. I can still go back to those either intangible assets or IND AS 16, whatever it may be. They use something called as concentration test. Has most of your purchase consideration gone only to acquire a few of those assets? Answer is yes, means only it's a asset acquisition, not a business combination. So this is what we will have to do for the purpose of business combination accounting, wherein now the standard has been sort of, after this asset acquisition amendment has been made, it will apply only in cases wherein the entity has been acquired completely. Normally what will happen is that we use the word called as assets acquired, liabilities assumed. This is a normal language used in business combination accounting. I acquire the assets, I also assume the liabilities. If it's only an acquisition of an asset, I may not necessarily assume the liabilities. I'll only acquire the assets. Liabilities will not become a part of this particular requirement. So I think that is what the standard is trying to talk about from point of view of acquisition accounting. So this is what I wanted to cover basically today. See, the other standards which I have not covered, PPE for example. We all know PPE, so I'm not taking too much of focus on PPE. The only difference in PPE and IND AS is that repairs and maintenance and spare parts should be capitalized. Option in AS, here any spare part useful life of more than 1 year have to mandatorily capitalize. Similarly, major repairs and maintenance which are incurred for the purpose of maintaining the value of the asset can also be capitalized. As far as classification is concerned, one last bit I will tell you all before I close. Classification in IND AS depends upon the purpose of use of the asset. The purpose of use of the asset will determine classification. Say for example, we are using for our own purposes, property, plant and equipment, no problem. Say we are using it for the purpose of rental or capital appreciation, investment property. Actually, rental, capital appreciation or unstated future use, rental, capital appreciation or unstated future use becomes investment property. Own use, PP, rental, capital appreciation, or unsettled future use, investment property. Suppose it is neither of these things. I want to sell the asset. One more is there. IND AS 105. Non-current asset held for sale. I classify it there, wherein I am neither using for my own purposes, nor am I using for the purpose of capital appreciation. I only want to sell it. I classify it as non-current asset held for sale, IND AS 105. The only major difference in IND AS 105 is that the moment I classify it in 105, I stop depreciating the asset. Unlike PP and unlike investment property, in the case of IND AS 105 asset, I will stop the depreciation immediately. Naturally, any one of these classifications can be turned back also. I can shift from investment property back to PP. I can shift from 105 back to PP. All these classifications and permutations and combinations are permitted. So what we need to remember very clearly is that the purpose for which the asset is being held would drive the classification in IND AS. That is a very important concept to remember, because it is very clear that when you use this word called substance or form in a very broad manner, it is very clear, just like how I told you for financial instruments. Why are they focusing on business model? Because of this concept of actions or the concept of substance or form. You take, for example, segment reporting, IND AS 108. They are not saying geographical segment and all those things. They are saying chief operating decision maker. Allocation of resources, they are saying, which means basically your budgets. I may have revenues from one particular source of segments, but I may be allocating a lot of budgets or support for other segments, which may not earn any revenues also. Those may become my segments for the purpose of segment reporting in IND AS 108. Need not necessarily be your geographical segments or product-wise segments. That also need not be there. So this is how your IND AS will probably work there. So I told you about property, plant and equipment, or we call it assets-based standards. I spoke about, say, your journal entries will most probably, of course, you have to do it for wherever there's an accounting entry passed, you have to follow this norm here. But generally speaking, if you look at the standards I've covered, for example, revenue, leases, financial instruments, that is where your journal entries will probably come maximum into use. This is what we have tried to do for today's session. So I think with that, I will end today's session and hand it over to the branch people. Thank you very much. The presentation is going to be there, and you all can probably view the presentation, and it will be uploaded on the portal, I think. It will be in the portal. Okay. Thank you. Thank you very much.
Well, thank you, sir. I see that there are no questions. You have this subject being very close to my heart. I mean, you have given everything in a capsule. So on behalf of Bangalore branch of ICI, SIC, I thank Mr. Mohan Lavi for this insights on the topic of key journal entries and working on IND AS. I request chairman to hand over a memento to the speaker. I would call upon chairman to give his concluding remarks.
Thank you, Pramod. I thank Mohan R Lavi sir for his time and sharing efforts, sharing his knowledge. Really, it's a very interesting topic. I think members enjoyed. Thank you all once again. Thank you, sir. Thanks a lot.